Greetings, Jonathan Camarda, CIO. Hopefully everyone's summer continues to go swimmingly. No pun intended, though. Be careful with all the shark attacks here going on. My old adage, swim in the pool and lay on the beach, or lie on the beach. Potato, potato. Let's get to the markets. I know how to pronounce most of that correctly. So last week we did hit the nail on the head there with the CPI, PPI numbers coming in obviously lighter, showing again a softer downward trajectory on inflation. Of course, the Fed's still going to lift 25 basis points, which has pretty much been set since the ADP numbers a few weeks ago. Nonetheless, and some of the Fed governors, coming out on Friday, still calling for another hike after that. We shall see, even in the face of lighter numbers. Inflation-wise. Another thing to look out for, which does not portend of a strong economy, is the largest gap here, the spread between the GDP, right, gross domestic product, and the GDI, which you don't hear about as much, gross domestic income. A large gap there with GDP slightly growing and a slight contraction on GDI, which is generally not the strong economy or strong inflationary winds blowing. But nonetheless, we'll see what the Fed does as we roll into September. Plenty of time to talk about that, so let's get to the markets. Markets right now showing strength, and it's amazing. We keep hearing about this as a narrow market. On the big three news stations, I'm not sure where the degrees are coming for some of these people, what they studied. Maybe it was philosophy or Socrates or something like that. But this market is widening out, and if you look at the number of stocks that are actually now above their 50 and 200-day moving averages in the S&P 500, it is not a narrow market. So it's a great talking point by all the bears, I guess, because they keep shorting. Okay, they keep shorting so much it's going from their ankles right up to their upper thighs. There's not much thread left. Now, with that being said, interesting note, as I say that metaphorically, the put-to-call ratio, that's the bets on the short end versus the long end, is actually at a pretty low level. So there is complacency in the market and a greed factor. So with all kidding aside on how everyone's talking about a narrow market, there is definitely a large amount of complacency out there. So what does that mean? Well, it doesn't mean anything, as the market wants to go higher, but it means that we want to have some caution, which of course we always preach here anyway. But again, some of the tailwinds that we're looking at, you look at technologies, industrials, semiconductors, all hitting new highs. Then you have some people go, well, yeah, it's all at new highs. I mean, no, that's generally bullish. When it breaks through, it does not fill the gap to the downside, at least anytime soon. Of course, eventually every gap is filled, technical analysis 101. But generally, that is a interim and a longer-term trend that will be in place. Another thing, we're looking at home builders as well, breaking all-time new highs. So as we look at the dynamics, what are we looking at? Longer-term duration bonds. Again, we've receded out of those as those continue to be negative. But the markets in general, small caps, mid caps have been coming up. Now, small caps are up against an interesting resistance level. We shall see if they're able to take out Goliath, the Nasdaq and the large caps, and to ascend or not. But the large caps keep rolling. At this point, one of the things you have to watch out for as well is we always talk about Forex and, the option markets and the such. And if you look at Forex, if you look at the USD, the US dollar, on one of the longest losing streaks versus the euro here, which again is good for our large multinational companies, also good for European companies. It's kind of the opposite over there, where a stronger currency there helps out their companies, whereas a weaker currency here, because we have so many large internationals exporting, right, more than Europe, that actually helps this country's large caps having a weaker currency. And the dollar is showing no signs of letting up on some of that weakness. Now, we've seen some of the metals kind of mixed. Gold has had a nice run. Silver we like right now as well, and certainly starting to stalk that, especially in strategies like active capital preservation. We shall see. And as we move on beyond that, energy markets are mixed, had a nice little run. And we have some participation there, putting our toe in the water, but we shall see in niche strategies, rather, easy for this guy to say, like Velocity Raptor and as such. Although the lean has been mostly, like I said, in the technologies, your consumer discretionaries, your consumer communications, et cetera, and which are the stronger parts of the markets, with industrial certainly getting a seat at that table too recently. Energy is kind of on that borderline. The supply dynamics from the Middle East are attractive for it. But of course, when we talk about China, we're not going to go too much detail into China, except you talk about the 100-pound weakling at the beach, talking about summertime. China can't even pick up the 8-ounce Coca-Cola off the sand right now. So very interesting there, and there's many different spins on that. I'm not going to get too deep on the geopolitical or the macro really on China. That's not what this is about today. But nonetheless, that could be a drag, is what I'm trying to say, on energy as well. Interest rate wise, obviously we still have an inverted yield curve. What does this mean for all the strategies? Well, opportunistic growth in income after making a recalibration in the spring to take advantage of the stronger sectors. Doing pretty well right now. Active capital preservation is a mix of different asset classes. Again, built to really hold up, especially during volatile markets like last year. And this year, again, to provide, a different mix of asset classes to reduce risk in your portfolio within a sleeve, right? As your personal wealth advisor describes to you, and clients that I speak to as well, you generally have a sleeve of strategies within an account, right? So we're going from macro to micro now, real quick. Don't change that dial yet. And so within a sleeve, you might have different portfolios. So you might have an aggressive strategy like All Stars, which is 5 concentrated NASDAQ stocks, which has done great this year with a lot more risk, which again got hit harder last year. And then a mix of more moderate or conservative strategies like the active capital preservation, which ends up being more of like a smart car, which in a school zone is great on the Autobahn or an up market. If you keep up with the metaphors there, not as much. And that's why you have a mix. Right, as most of our clients generally have built their fortunes, have built their legacies, and so it's a balance of continuing to grow at the same time, proper risk management, and that's something that's not talked about enough out there. So with that being said, going through the strategies, macro momentum, sector momentum continue to be deployed nicely, taking advantage of these markets, and then of course, as we round out with global macro tactical, which continues to rip to the upside as well, taking advantage of some of the stronger individual equities we won't mention here on this program, but you can see inside of your accounts. Again, talk to your personal wealth advisor as you're going through your statements. Pretty attractive spring. If you have any questions or you feel, for example, the overlay of your risk appetite and the mix of strategies that you have in your accounts, certainly a conversation. And then don't forget as well, as we get into quarterly communication time, as well as I've spoken already to a lot of my clients and in the process of, is that you want to discuss, again, longer term situations, income changes, risk management changes within your household, and how we might adapt the percentages of strategies, as I've been talking to clients with different income situations, or again, retiring and moving more assets, and how that allocation will take place as well. So generally, I know I'm talking more of the quant on the markets, but since it is, statements roll out on a quarterly basis and as such, did want to kind of get into some of that financial planning and put on that rare time that I put on that CFP hat. All right, so with that being said, stay cool, stay eternally vigilant. That's what we'll do. Stay frosty, and until next time, swim in the pool, lie on the beach.